Hello, welcome to everyone. In this new video tutorial, we are going to discuss about implied volatility and historical volatility. What's the difference? What's the meaning? Let's start then from the definition. As in other video tutorial as well, we always invite to have a look to the former videos where we explain other basic concepts. Alright, let's move to the historical volatility. It's a common mistake to confuse the two volatility, implied and historical volatility. Historical volatility is always related to the underlying, so the stock share and other linear instruments, while implied volatility is typically related to the options. So in other words, the historical volatility defines the variability, the movement over the last X days, whatever X is, such as 6 days, 10 days, 20, 100. In this graph here, you see indicated different historical volatility for the different last X days, 6, 10, 20, 100. In a sense, the implied, from an intuitive point of view, the historical volatility, it says me how the price has moved in the past. And to be more precise, it indicates the amplitude of fluctuation in prices over a certain past period, 6, 10, 20, 100. There is a precise mathematical formula which calculates the average over the last X days, and then it calculates the square difference between the daily price and this average. But once again, from an intuitive point of view, historical volatility says me how much the price was moving in the past compared to the average. From this graph here, you see in this example, the underlying, the stock share, is moving less and less from the last 100 days till the last 6 days, from black to red. Alright, as anticipated, the implied volatility instead is related only to the options. It's a variable which is used to determine the price, the premium, the option premium, and it is always referred to the future. Implied volatility represents the market expectation on the future volatility, which means what should be the volatility of the future, and that's the implied volatility. As we said, an I value is reflecting on the implied volatility is reflecting on the premium option. So if the implied volatility is high, even the option premium is high. That's because there is an uncertainty expectation for the future. Let's have a look to this example. The underlying NDX is in blue, and there is more fear and uncertainty regarding the future, which means the implied volatility in red goes up. So you see, when the underlying starts to goes down, then the implied volatility goes up. Typically, these two the underlying and implied volatility are typically inverse to each other. So if the underlying goes up, then the implied volatility goes down, and vice versa. So in fact, when you see the underlying goes up, it means that there is an expectation of calm for the future, and then that is reflected in the implied volatility, because the operator are expecting a calm for the future. In few words, this is what is going on. Also for the implied volatility, we can plot the implied volatility as we did for the historical volatility. But once again, the historical volatility is always referred to the past. Implied volatility can be plotted as well, but it's related to the future. So in this example, you see the day by day on the horizontal axis, the implied volatility graph for the next and not for the past. For the next 30 days, red line, from 30 to 60 day, blue line, from 60 to 90 for the green, and for more than 90 days in black. You may notice that when there is an important event such an earnings, you see here in this green triangle where you see the E letter, the short-term IV, the red line, it climbs exponentially high, and after the event, it's tumbling down immediately after the news. This is very clear, for example, here where we have this earning. Prior to the earnings, the implied volatility suddenly climbs up, and after the news, then it's tumbling down, because after the news, the expectation of the market is an expectation of calm. You see even here as well. And that's more evident for the short-term implied volatility, the red color. It's also reflected on the medium-term implied volatility and long-term implied volatility, blue and black. But in this case, the event is less sensitive. Alright, we close this short video tutorial discussing about the VIX. It's also called Fear Index. VIX is the Chicago Board Option Exchange Volatility Index. It measures the implied volatility for the option price, which is the front month of the S&P 500 options implied volatility. VIX is saying me whether there is a fear or not on the market, and in fact sometimes it's also called fear index. It identifies the short-term operator expectation in terms of calm or fears. So when it's high, it means that the market, there is a fear expectation over the near future, over the short-term future. So it might be an idea, well, it's exactly the approach for the operation with option, to sell the option when the implied volatility or when the VIX is very high and it's starting to decrease, while it's a speculative idea to buy when it's low and it's starting to increase. So here we sell options, and in this phase we buy options. I'm going to describe the reason of that into detail by analyzing premium, time, implied volatility in another future video tutorial. For the moment, I'm gonna stop here. I want to thank you for watching this video. I invite you to have a look even on the other video as well. Don't forget to visit our website, trade-systech.net, where you can see other information regarding the trading articles and video. Thank you so much. Bye bye.